Hey, let's dive into this explainer and demystify how real estate capital gains tax actually impacts your wallet.
Selling a property soon. You're probably wondering if the tax man is going to take a huge cut.
Capital gain is literally just the taxable profit you make as an individual when selling real estate.
The law targets actual wealth increases, shielding you from fake gains driven purely by inflation. Pretty neat.
So here's the golden rule. Hold your property for 5 full years, and it's completely tax-free.
Whether it's a house, empty land, or a commercial spot, this 5-year rule applies pretty much universally.
Also, you're totally off the hook if you got the property through an inheritance or a free gift. But beware, systematically flipping multiple properties gets heavily taxed as commercial income instead. No loopholes there.
And get this, corporate taxpayers and real estate pros are strictly excluded from using this personal exemption. Even quirky situations, like bartering land for an apartment or compulsory executions, can absolutely trigger this tax. To calculate your gain fairly, you adjust your original purchase cost for inflation using the DPI. That's the Domestic Producer Price Index. You use it provided inflation jumped by 10% or more.
This handy formula tweaks your original cost using the exact index from the month right before you sell.
Next up, you deduct out-of-pocket expenses like title deed fees, agent commissions, and official appraisal costs.
Plus, for 2026 sales, you get a sweet tax-free exemption of exactly 150,000 Turkish lira.
So take your gross gain, snip away those deductions, and apply the exemption to find your taxable base.
Finally, multiply that taxable income against the progressive tax schedule, and boom, there's your final bill.
Before selling, ask yourself, have you hit year 5, or are you accidentally triggering commercial tax rates?